Robert, I'm going to begin with you. Why do you think we're seeing such a sharp reaction in the pre-market this morning? Do you think it's all based on that Moody's downgrade, or are there some other factors putting pressure on futures?
You're coming out the hills of the Moody's downgrade. It does take the market in the yield curve. Anytime you see something like that, not surprised, but let's be clear right now. The deficit and the debt is all this administration has been talking about. So as Scott Bessent said, this could be late to the party.
I also want to ask, we're seeing tech under a lot of pressure right now. Now, generally, when we think about tech, we think of them kind of being immune to rising cost of capital. Do you think tech specifically is being hit by these rising yields? Or is there something else weighing on tech names like a Palantir we're seeing down about 5% and some other big names like that?
We just came off 5 days of the markets moving higher. So to have the opportunity right now for the markets just to settle in. Tech took the hit. They were up 7.2% if you look at the NASDAQ last week. So just taking a breather right now. But at the end of the day, big tech has cash. So they're not immune 100% to rates, but it is something for the mid to lower cap companies in the tech space more sensitive to rate movement.
Gilbert, coming over to you. A lot of action in the bond market this morning. We're seeing the 2-year very close to 4%. But the real headline here is the long bond, the 30-year, back above 5%, highest level since October of 2023. What do you make of this move when we're talking about yields?
Yeah, first of all, I think that I agree with the Treasury Secretary that the rating agencies are lagging. In my view, it's amazing that it took them almost 12 years, maybe almost 15 years to catch up with S&P. But here we are. There's movement. This is an excellent opportunity to be adding bonds and adding duration. We're essentially exactly where we were when we had the pause with China to begin with. That's when 10-year went to about 454, and that's exactly where we are now. I think it's a great time. In fact, in my view, the more interesting thing is to see the 2-year now over 4%. I think you're going to see a lot of people lock in that type of rate, especially money market people, short-term people, because that is where a lot of value exists.
So, Gilbert, I just want to be clear. You're saying you agree with the Treasury Secretary, but for opposite reasons. He's basically saying it's a lagging indicator. It doesn't reflect what he believes is the current economic situation, this downgrade. He believes that, the tax bill is going to pass, some other things are going to happen, they're going to improve the economy. You're saying that we should have been downgraded a long time ago? Is that why you're saying it's a lagging indicator?
That's exactly right, because we've seen this reaction in Washington, the difficulties. This is not the first time that we've been having struggles with a budget deficit, the continuing resolutions, all those things. This is kind of the way things are now in Washington. So in my view, this is already or should already be built into the marketplace, certainly in the bond market. So this is an excellent opportunity to really buy, add in, lock in these higher yields, because in my view, things are going to be looking forward. We're going to recognize that the tariffs are really a worldwide tax. And when you look at some of the leading indicators, and I mean things like consumer confidence and the like, you're already seeing consumption starting to slow. You're already seeing CapEx starting to slow. We already know they want to shrink government expenditures. And all those things are going to lead to a much weaker GDP.
All right, Robert, coming back over to you. It seems like after a week of a lot of enthusiasm, some big trade deals, and again, that temporary tariff pause between the U.S. and China, some uncertainty has been kind of injected back in the market. So we heard from Treasury Secretary Scott Bessent saying that countries that don't negotiate in good faith, they're going to see their tariff level go back to the April 2nd level. And at the same time, we saw some Republicans push back on the quote-unquote big, beautiful bill. With that in mind, where are you seeing opportunities in the equity market, knowing that there might be some other disturbances and disruptions?
Right now, you want to look at recession-proof large caps. We like Netflix. We have for a long time. They're doing everything right. You got acceleration on the top line and bottom line revenue growth. But at the end of the day, if we have a recession, at Netflix, numbers go up. People spend more time streaming. And also the growth elements that they have moving forward. It's one of those recession plays that we really like.
All right, I'm looking right here. One of the other picks is Berkshire Hathaway. Some news over the weekend, actually, that Warren Buffett says he's really going to step back. He's not going to speak at the next annual meeting. Of course, we know Greg Abel's taken over as CEO. In your mind, does that change your view of the stock at all, knowing that Warren Buffett is taking a decidedly bigger step back than maybe people thought just a few weeks ago before the annual meeting?
Not at all. Warren Buffett has all the confidence in the world for Greg Abel. And also, if you look at the $350 billion that Berkshire has, they're starting to put it to work. They just put down $12 million investment in Constellation Brands. You're thinking Corona, you're thinking Modelo. Maybe Warren Buffett's thinking about retirement, maybe a Corona on a beach somewhere in the future. That just gives you the indication from him that I think he's okay with his choice, and the board is well in hand. And I think the management is going to do well many decades to come.
I do believe I think they doubled their stake in Constellation Brands, so maybe he is thinking about that Modelo. One other question for you, Robert. You say right now you like financials, in addition to healthcare, by the way. What do you make of that Fed report from last week showing that we're talking about small, community, and regional banks, that the unrealized losses specifically tied to treasuries and mortgages seems to be rising? Do you like that section of financials, or do you only like the big money center banks?
Just the big money center banks right now. Again, as rates move, you have small regionals that are more sensitive to that. So then that translates into earnings moving forward. But the large cap banks show tremendous value even moving forward.